into VTV, Vanguard's Value Fund. When we take a look at the fact sheet, it's a value fund with an expense ratio of 0.04%, with a scheduled dividend that's quarterly that hovers around approximately 2.5%. Here is the since inception date, which was about 8%, and the overall 10-year track record is about 10%. It's a relatively large fund. When we look at how they compare expense ratios to other funds in the industry, I know it says 0.93%, but that's also including hedge funds that they don't tell you about, which might rely on other strategies, especially hedging or more complex fund strategies that aren't predicated on more passively managed funds, which is what Vanguard is trying to emulate. We'll get into the backtest a little bit later, but here are the top holdings. The interesting thing about that is it has Berkshire Hathaway, which is actually a fund that outperforms this fund by a huge margin, and also JP Morgan also outperforms this particular fund by a huge margin. When you look at Broadcom, which is kind of weird about this ETF, is that Broadcom has a PE ratio that hovers around 45%, so I'm not sure what value quote stock they think this one is, but anyway, we'll see that a little bit later on. Here's the prospectus. You can always find this at the website. This just goes over the 0.04% expense ratio again. Moving on to the backtest. Just for benchmarking, we used Berkshire Hathaway, JP Morgan, QQQ, and VTV. When we hit analyze, the interesting thing is that when we put all these funds together, initial starting balance of $10,000, JP Morgan, you end up with about $86,000 over the past 20 years or so. Invesco QQQ ends up to being well over 120. Vanguard, just under 50,000. Berkshire Hathaway, which is 71,000. So mostly VTV underperforms everything. And then Berkshire Hathaway tends to be rather in lockstep with the S&P 500, so the value ETF that Vanguard has underperforms that as well. But the interesting thing about this is that when you look at JP Morgan has a similar max drawdown to the Vanguard ETF. And JP Morgan, when you look over here, has a lower PE ratio than VTV. At 17.44%, 17.44 for its PE ratio. So JP Morgan is more of a value stock than Vanguard's ETF, which is fair. It is one company, but when you look at Berkshire Hathaway, which is an actual, investment firm that, is similar to what Vanguard's trying to do, it has an even lower PE ratio than what Vanguard's trying to do. So I don't know why you wouldn't just buy Berkshire Hathaway if you were invested into value as a strategy. Also, one thing to consider is that even though there's a lot of drawdowns, something to consider is that even with Berkshire Hathaway, if you consider a more buy and hold and contribute a fixed amount like dollar cost averaging strategy, when you invest monthly and you hit analyze, drawdowns kind of function a little bit differently. When you look at all these, of course, the time-weighted return, Berkshire Hathaway kind of, they perform fairly similar. Time-weighted returns are right here. So this is VTV, and then this is Berkshire Hathaway. Now, JP Morgan is asset 1, and QQQ is asset 2. So your money-weighted returns with these drawdowns, the thing is that when you make a couple of assumptions, one is that the fund won't go to zero. Two is that the fund always recovers to its previous high eventually. And three basically volatility can actually be, with those two assumptions, volatility can actually be what you consider a discount to the price overall fund, which could potentially boost returns, which is why you see a money weighted average that allows some of these funds to outperform even more than their time weighted returns. So with that in mind, it doesn't look like VTV is a, I mean, I'm not going to say it's a bad fund. I'm just going to say that the fund that they have, like the Berkshire Hathaway does it better. There's also other funds that might be more expensive that are pretty similar, but then again, Berkshire Hathaway is pretty similar to S&P 500 in the past recent years. So, I mean, you could just roll with FXAIX, which is the Fidelity S&P 500 fund, which has a P ratio of 0.15%, which basically returns the same thing and has similar drawdown characteristics, because this one's the worst drawdown even compared to QQQ. QQQ has less of a drawdown than JP Morgan, but you get more drawdowns with VTV, you get less returns with VTV, and your money rated return is not as good as some of these other ones. So I mean, it doesn't look like a very compelling option, considering that alternatives would be cheaper in expense ratio, return better, and actually follow a value strategy of actually looking at their expense ratios, actually looking at their PE ratios, or just deep diving funds. So I'm not sure what their strategy is. When you look at the prospectus, it's just a bunch of gobbledygook. When you look here, seeks the performance of the large cap value index. I don't know what that means. Large cap value equity. Cool. What is that supposed to mean? Manages passively managed full replication strategy. So they're not really picking anything for you. So if you're going to go with an index, go with an index that returns more. I'm just saying. Because when you, like, if we could just compare VTV and we get rid of this just so that we can see the tickers. Yeah, 52,000. The returns are better, less of a drawdown by 2% in returns and max drawdown. And it's less expensive than VTV. So, you make the choice. There's also other things to consider about a fund, because the Fidelity Index doesn't return as much of a dividend. But if you were looking for a dividend, JP Morgan has a forward dividend yield of 2.48%, which is about 0.1% more than VTV offered. So, I mean, JP Morgan is more of a value stock than anything else, and JP Morgan has been around for, let alone, $1871. So just something to consider. But thank you for watching the video. Take care.